What is up, my mortgage friends? Welcome to another Monday market update. My name is Sean Grapevine. I am the director of Agent Direct, which launches today. So wish us luck. And I am joined here this Monday, as with every Monday, by the Sultan of SLAs, the king of collateralized debt. He's the colossus of credit, the titan of the 10-year. He's the great Bambino. He matches his asset durations to his currency outflows, and he's like the Sergio Perez holding off the Fernando Alonso like wily old campaigners of this antiquated industry. His name is the one, the only, Austin Koenig. Welcome, Austin.
Thanks, Sean. I appreciate it. Great intro as always. It's always great to join you on this Monday market update, and we've had quite the drama. Obviously you mentioned F1 right there. F1 has plenty of drama, but
I
F1
know
can never have the drama.
Lance Stroll with an electrical failure in the middle of the Saudi Arabia Jeddah GP. I mean, there was a lot of drama this weekend. You're right.
No
What
question. Well, when we're talking about what's happening in the news, obviously there's been a lot of news when it comes to banks, and really kind of the cracks in the system that are starting to happen because of the Fed's very restrictive policies. So I think really the main thing to cover, really to kind of recap the weekend a little bit, is Credit Suisse was bought by UBS, but it was really considered a bailout.
Sure.
And it kind of really catching up with those who are in this market, who are on the Wall Street side. This bailout does mean certain things that can affect investor sentiment to an extent in the Wall Street world, but generally this is something that needed to happen. UBS kind of come in and save the day, but they obviously did get Credit Suisse for kind of pennies on the dollar here. Definitely something that is very interesting to see. We have a couple other banks that may be slightly under pressure. However, this, I think, really at the end of the day provides us a lot of solace in terms of our position within the market. We are obviously independent. We're not a bank by any means. So we have different games that we play in terms of, like, we have to always be next to the market, right? Like, we
Sure.
are constantly repricing based on the market, and the market in the world of rates has gotten better since we've really seen the 10-year float above 4. We're a lot different than we were a couple weeks ago, and who stands to benefit there is really the borrowers and you guys as loan originators generally, because we're seeing lower rates, but in general too, I think it's cheaper to get a lower rate. Kind of looking at the rate stack, opening that up, and seeing okay, do I really need to originate a par, or hey, like, you can buy down your rate by this many bips. Like, let's say you can get half a point off your rate for only 60 bips or only 70 bips.
Right.
It's really
super
beneficial
cheap
to buy that
down.
rate stack.
Now, do you think that those are the future? If this 10-year sticks where it is, if there's a little bit of calm that enters into the fixed income markets, do you think that those where we see, okay, well, like, hey, it's a lot cheap, like you can buy down the rate half a point at 60 bips. Do you think that some of the premium is going to go to those? Like, will those be our new par rates if things stick around, where they're at in the bond market for the next week or two?
Yeah, so I think generally volatility is never fantastic for mortgage bonds. But what we're looking at, what we have in front of us here, I think what we could just really hope for is kind of a path forward that the market has priced in, that matches what the Fed talks about. So we have a Fed meeting on Wednesday with a rate hike or no rate hike announced Wednesday afternoon at 2 p.m.
What's your guess?
Oh, this is a tough one. I would have to say, I still think there might be a 25 bip rate hike. However, I think the matter of fact here that we have to deal with is, what do they do after this? What do they kind of showcase as their playbook now? Because I think everyone can pretty clearly see that the policies have had effects now. We've obviously seen inflation come down, not to maybe the speed that we want to, but you know, financial stability is starting to weaken. It's
Sure.
not necessarily like a broad, complete, you know, a break of the system, but we've seen some fairly large banks such as SVB fail. Credit
Mhm.
Suisse is not an American bank. It operates in America through
Right.
a couple different ventures. Obviously, their investment banking, their Wall Street businesses, but they also own other businesses
Mhm.
as well in America. But generally, though, they are not an American bank. They're not really something of the Fed's direct concern or oversight compared to maybe someone like SVB, for example. But
Sure.
generally, though, I think what we have to look at here is how does the Fed react to these things? And Credit Suisse was a bank that was under trouble for really all the years past the financial crisis.
Yeah, it's like this sucks for them, but like they've been on the edge of failing for like the last. They've been in trouble for a while and on the edge of failing for the last 2 years. So it's sort of unfair. Like this is kind of the straw that broke the camel's back, but like everybody's known that they are just a step away from oblivion for a couple of years now, I think.
Yeah, exactly. And generally though, like we have to kind of spin that positively, right? I think generally like at the end of the day, they're going to step out of this market probably regardless of what happens in the future. If we had to look in the crystal ball, Credit Suisse probably looks different than it did in 2022. If we're looking at any year in the future, it was bound to happen. It just happened, all kind of at once with everything else that's going on. Here's what I think we have to just focus on is what the Fed's going to say, how we look at future rate hikes in the future, as well as just how the market reacts to it. We saw a couple more hikes priced in a couple weeks ago, and obviously the bank stress started to happen, and we've seen rates come down from there. What's priced into the market is kind of unclear because there's a lot of flight to safety that happens each day, and sometimes then there's a little bit more of a risk appetite that happens the day after, or a couple days in a row after. So I think right now what we just need to kind of find is what the market's going to price in, what the Fed actually does, and kind of find a level footing because before this, we were kind of at a level footing and we knew kind of what the Fed was possibly going to do here. Right now, what they project at this meeting is really going to, I think, send the market, scurrying a little bit. But hey, we have to prepare for all kinds of outcomes, and business goes on at the end of the day. Like, and there's no stopping. Like just like you at Agent Direct, we're not going to stop Agent Direct because of what the Fed says. We have to keep on going, right? So it
That's
is what
right.
it is.
That's right.
We just have to keep on trucking.
We're gonna start. In the middle of these headwinds. It's like Anthony sent out that email this morning, and there are a lot of market headwinds. Like this, this sucks. But like for us, it's an opportunity, and for like we know all there is to know, right? If you're a loan officer at this day and age with all the access to information you have, the Monday market update and other lesser things, then you really know all there is to know about the market compared to 99.99% of the population. So if you're feeling a little nervous, then like you can only imagine how your clients and agents are feeling. So it's not the time for toxic positivity. It's not the time for projecting false confidence, but it is the time to educate people. Right? Education is going to help people's understanding of what's going on. It won't seem so like ephemeral and hard to understand. And then it's a time to show people where the opportunity lies here, right? Like, okay, there's banking issues, but like rates are lower, right? If you're in the market, like, and you need a house, then like this might be a fantastic time to go buy a house. And I think this is an excellent opportunity for us as loan officers to pick up market share, right? Like it's like what Warren Buffett says when when others are greedy, it's time to be scared. When others are scared or fearful, it's time to be greedy. And so when there's blood in the streets, it's time to go out and take what's yours. A lot of people let anxiety get in the way of pushing, get in the way of prospecting, get in the way of trying to take market share and become a presence in their local community. And it really is the best time to do that. This is when you can gain the most visibility, when the most people are sitting on the sidelines. and when you can actually bring some differentiated value to your community and to your network.
No question. Well said, Sean. I
Yeah.
think just a couple quick things to recap what happened last week as well, other than obviously all the news about Credit Suisse. We had two inflation numbers come out, CPI and PPI, right? So this is going to be interesting to see how the Fed talks about this stuff as well. So what we saw with CPI, nothing monumental, nothing great.
Mm-hmm.
PPI, which is the kind of what the producers, are demanding and or what costs they're facing, that actually showed definitely some slowdown, which was good. That was a good data point. Really, I think the data point of solace. Now, there's a lot of other things happening in the market that the market didn't really react to. Let's say if it was any other normal week, I think that would have been a good day for the market generally to see that.
Right.
But we'll see what the Fed has to say about that stuff too, because there's obviously CPI is not slowing down. Oil has come down. I actually had a really bad week of the past 2 weeks, and generally that'll help with the non-core inflationary numbers. So we'll see what happens in the months to come, but. Yeah, I think we have a lot of good things to cover and an exciting week ahead of us, especially with Wednesday's Fed meeting. So we'll be all ears for that.
Yeah, I'm looking forward to the Fed meeting. I would just say, LOs out there, bank on volatility, and it's all no matter good news, bad news, anything like that. It's always a good time to get in front of your agents, be the first to the phone, first to the text message, letting people know what's changed and that you're there to help. All right. Well, looking forward to this Wednesday, like I said, and next Monday. If anybody has any questions about capital markets or fixed income markets or equity markets or any sort of market, really, farmers markets, drop them in the comments and we'd be happy to help.
There we go. Love it. All right. Well, thanks, John. I know we'll wrap it up here. Thanks, everyone, for tuning in. Have a great week, and we'll see you guys next Monday.
See you, everybody.